Hey everyone, welcome back to the FluxFolio Finance Channel, your go-to source for breaking down the biggest financial stories shaking up the global economy. Today we're diving deep into the US Treasury market, a cornerstone of the world financial system that's under serious pressure right now. We'll unpack why treasuries are so vital to the US, how foreign holders like Japan, China, and the EU are shifting the balance, what rising yields mean for businesses, and where your money might be safest if inflation spikes. Plus, we'll explore China's potential currency manipulation tactics, the game theory dynamics in this trade war, how much treasury debt is maturing this year, and what the Federal Reserve might do next. This is part of a massive economic showdown. Let's dive right in and keep the momentum going. Let's start with the basics of the US Treasury market. As of April 2024, the total outstanding U.S. Treasury securities stood at $36 trillion, according to financial analysts on WolfStreet.com. These securities range from short-term Treasury bills, maturing in weeks to a year, to long-term bonds like the 30-year Treasury note. Treasuries are considered the world's safest asset, backed by the U.S. government's credit, and they play a huge role globally. They're a benchmark for pricing everything from mortgages to corporate bonds, and the Federal Reserve uses them to manage monetary policy, like during quantitative easing. For the U.S., treasuries are critical because they allow the government to borrow at low rates due to high global demand, funding deficits without immediate consequences, as long as confidence in the dollar holds. But that strength is also a vulnerability. About 70% of treasuries are held domestically, by U.S. banks, companies, and the Fed, which holds $6.8 trillion as of March 12, 2025, per U.S. bank data. The other 30%, roughly $8 trillion as of January 2024, is held by foreign investors, per Statista. Japan is the largest foreign holder with $1.15 trillion as of April 2024, followed by China with $797.7 billion. The EU is a major player too, holding over $2.5 trillion as of April 20, 2025, with Luxembourg alone owning $400 billion despite its population of just 675,000. But recent moves by Japan and China are creating serious pressure, and that's where the tension begins. Let's break down the shifting balance of Treasury holdings. Japan has been selling off treasuries, offloading $47 billion by February 2025, while China sold $50 billion, bringing its holdings down to $784 billion by February 2025, per Reuters. This selling floods the secondary market, where treasuries are traded after issuance, with supply pushing prices down. Since bond prices and yields move inversely, this has driven yields up sharply. The 10-year Treasury yield jumped from 3.5% on April 4, 2025, to 4.5% by April 8, 2025, per Brookings, and climbed further to 4.59% by April 16, 2025, per Reuters. This rise is tied to declining foreign demand, with Japan and China possibly shifting to gold to avoid U.S. sanctions risk, as noted in a Kepler report from January 15, 2025. Higher yields mean higher borrowing costs for the U.S. government, which strains future budgets as more money goes to servicing the $36 trillion debt. They also signal fading confidence in treasuries as a safe haven, as Euronews reported on April 9, 2025. Domestic holders add another layer of complexity. Some might be influenced by foreign entities like China, as the U.S. navigates this trade war. If they short treasuries, betting on a price drop, it could amplify the sell-off, forcing the U.S. to buy back debt to stabilize the market, a move the Treasury considered on April 15, 2025. This ties into strategies like the Mar-a-Lago Accord, using uncertainty to drive Treasury demand, but rising yields are making that plan harder to execute. What about the EU's role in this crisis? With $2.5 trillion in U.S. treasuries, the EU holds significant leverage. But will they short the U.S., either by selling treasuries or shorting U.S. stocks? If the EU sold just 10% of its holdings, that's $250 billion hitting the market, which could spike U.S. borrowing costs, especially with significant treasury debt maturing soon. Shorting treasuries would amplify the sell-off, driving yields even higher. The EU could also short U.S. stocks, European hedge funds might target equities if confidence in the US economy falters, as global markets dropped 5% amid tariff tensions in April 2025. But the EU might hesitate, selling treasuries risks US retaliation, like the 10% tariffs on EU goods, and could devalue their own portfolios, since a weaker dollar impacts global trade. Speaking of maturing debt, let's look at what's coming due in 2025. According to the US Department of the Treasury, about $3 trillion of US debt is expected to mature this year, much of it short-term, which could strain the market if demand weakens further. Some financial analysts have speculated a higher figure, up to $9.2 trillion, but the Treasury's estimate of $3 trillion aligns more closely with official data. Specifically for June 2025, the Congressional Budget Office reports that $147 billion is due, including $132 billion in securities held by government funds and $15 billion in interest payments, set to mature on June 30. This looming maturity adds pressure on the Treasury to refinance at higher yields, potentially worsening the crisis if foreign demand continues to drop. Now, why do higher Treasury yields lead to higher loan rates for businesses? The 10-year Treasury yield is the benchmark for many loans, like mortgages and corporate borrowing. When it rose from 3.5% to 4.59% in April 2025, borrowing costs for businesses increased significantly. Higher interest rates mean companies pay more to borrow, discouraging investment in new projects, hiring, or expansion. This leads to less company activity, lower retail spending, and slower economic growth, a ripple effect we've seen before, like when Japan's Nikkei fell 4% on April 10, 2025, per The Guardian, during tariff escalations. For the US, the deeper issue is maintaining confidence in the dollar as the world's reserve currency, something Scott Bessent emphasized at the IMF and World Bank meetings on April 23, 2025. If treasuries lose their safe haven status, the US can't borrow cheaply or print money without consequences, risking a global financial shift. Let's dive into China's potential currency manipulation. China could manipulate its currency in several ways. The People's Bank of China could sell treasuries directly, Chinese commercial banks could sell, or China might buy treasuries to fake market confidence before selling at a peak. A fourth method is forex intervention, selling dollars to buy yuan, weakening the dollar, as noted in the Treasury's November 14, 2024, report. But that report found no evidence of manipulation through June 2024, though China remains on the monitoring list for its opaque policies. A fifth tactic could be promoting a digital yuan as an alternative to the dollar in global trade, a long-term play. Selling treasuries en masse would hurt China too, strengthening the yuan and making exports less competitive, as Bessent noted on April 18, 2025, per Reuters. This brings us to game theory: who sells first? If China or Japan dumps treasuries, others might follow to avoid losses, driving yields higher. The EU might join in, as we discussed, amplifying the crisis. The US could print money to buy back debt, but that fuels inflation, eroding the dollar's value and spreading risk globally, since the dollar is the reserve currency. If inflation spikes, where should you invest? Gold is a strong bet. Its price has risen since September 2024, per Kepler, as foreign buyers like China stock up. Bitcoin and cryptocurrencies are another option. Bitcoin hit $109,079 on January 20, 2025, and was at $95,000 as of April 23, 2025. Solid companies in stable sectors, like utilities, could also hold up. Money flows to assets with strong narratives: gold for safety, crypto for decentralization, or firms with steady cash flows, but fundamentals matter most. Let's consider three possible scenarios. First, if all countries comply with US policy, yields stabilize, and the dollar stays dominant, best case for the US. Second, a mixed response: some comply, some don't, which is realistic. The US might redirect money to allies, buying their assets and selling at a profit. Third, a prolonged trade war divides the world into Team USA and Team China, with an 81% trade plunge per the WTO, leading to economic devastation. Money keeps printing, inflation soars, and capital flows to safe assets like gold or European bonds. Both economies suffer, but the US's ability to print dollars gives it an edge, at the cost of higher inflation. What can the US do? A deal with China might be near, markets expect one soon, as Reuters hinted on April 23, 2025, with de-escalation signs. The Fed's role is tricky. On March 19, 2025, it held rates at 4.25% to 4.50% and slowed its Treasury runoff to $5 billion monthly starting April 2025, per US Bank. Should the Fed follow government policy? No, it's independent. It should wait for clear signals, like a liquidity crisis, as it did in March 2020, buying $360 billion in treasuries to stabilize markets, per Brookings. Finally, the secondary market is where the real action happens. Hedge funds unwound basis trades, fueling volatility, as Reuters noted on April 11, 2025. Foreign buying at auctions was strong. Indirect bidders, including foreign investors, showed huge demand at 10-year and 30-year auctions in April 2025, per WolfStreet.com. But overall foreign demand is dropping, and that's the core issue. The US Treasury market is under pressure, yields are up, foreign holders are selling, and inflation looms. Thanks for tuning in to FluxFolio Finance Channel. Hit that thumbs up, subscribe, and ring the bell for more deep dives like this. Drop your thoughts below. What's your take on this Treasury crisis? We'll see you in the next video.